could swing. So wherever it captures in that swing, whether it's high or low, could really affect the score that's generated. And it's not always the same because they reported different days. But to get to a little bit about what Tricia said is that different algorithms or formulas are used that consider some different things, right? And we all hear about algorithms today that are used in social media and different things. It's just an algebra problem that's used to figure something out, right? You put the numbers into this formula and it spits out a response, right? But maybe what you didn't know is that there are over 100 different ways to compute a credit score. And I usually pause there for effect and let everybody soak that in. 100, Owen's laughing, 100 different ways to compute a credit score. And we all believe, and most people that you're going to deal with that are thinking about buying a home have a number that their phone told them. Then that's their credit score, right? Right. But the truth is that a credit score really depends on what formula was used to derive it and where it came from, right? As to what it can do for you, okay? So that's partly what you're dealing with when you are talking with someone that says, well, you know, my phone says I have a 620 credit score, so doesn't that mean that I can buy a house? And the answer is maybe, right? We don't know. We've got to see what the mortgage score is and why is that mortgage score different than your phone, right? So this is probably a good point for Chris to pick up and talk about now a little bit more specifically about FICO and how that relates to credit scores.
So what is FICO? Who is FICO? I think, you know, since I've been doing this, it seems like when I started, unless you were a lender, you didn't know what the heck FICO was. No one knew that term. But now it's I think it's a popular term that gets thrown around out there quite a bit. In that, you know, when you hear it all the time, or you may see it when you log into one of your apps, like, oh, this is a FICO credit score, so therefore it's correct. And that's not always true either. So FICO stands for Fair Isaac Corporation. Now, who are they? Well, they basically invented credit scoring. Back in the 60s, Mr. Fair and Mr. Isaac got together and they said, hey, let's come up with a system, a number-based system that we can sell to banks and lenders that they can determine, well, what's the likelihood of a consumer to pay back a loan, so they don't have to go through mountains of paperwork to underwrite a loan. They can actually look at a number and have a better idea. Now, there's still mountains of paperwork today, but it was even worse, you know, way back when. So FICO invented credit scoring, and they are the law of the land in 90% of all lending decisions that are done out there. Now, there's 49 different FICO algorithms. So you thought you were confused when we talked about 100 different ways, but we point that out in that there's 49 different FICO algorithms. The reason why is because I think a lot of people think that, oh, okay, your FICO score is your FICO score. Just like I think people used to understand that your credit score is your credit score. Then they think, oh, I'm getting smart. Now it's just FICO that I need to worry about. Well, no, not really. Because when you walk into a mortgage lender, they are going to pull a mortgage-based FICO algorithm. Okay. Now you think you got it, right? No, you don't. There's 9 different mortgage FICO algorithms. Okay. But there's 3 that are used. So I'm going to try to make that as easy as possible. This is probably the easiest thing, is that there's one for TransUnion, one for Equifax, and one for Experian. So for example, when Owen pulls up a credit report, okay, it's actually going to have the name of the algorithm listed on the credit report for each credit bureau. Okay. Beacon 5.0, Classic 04, Fair Isaac version 2. Why do we use those 3? Because the people that buy the loans are the people that said, these are the algorithms that we want to see. Okay. Now, when I got started in the business, 13 years ago, it wasn't always like that. You could go to different banks and different algorithms were actually being used. But then when it started happening is the investors said, you know what? I don't like the way this loan is performing using this particular algorithm. So we're going to only buy loans if it has this algorithm that was used on the loan. So then it actually changed the way that the credit scoring was done for everybody. So now it really is down to those three. Now that could change. The one thing we all know about the mortgage industry is that the only thing that stays the same is that everything changes, right? Um, but this is why I think it's so important to talk about. And when we do home buyer seminars, this is probably one of the biggest things that we go over with people, and one of the biggest questions that home buyers have. And I'm sure it's a big question that you guys have. So this is why it's so important. And the one big takeaway, if you're going to have anything from this class, is going to be this section here, to understand that the credit score that they're seeing is not necessarily going to be the credit score that they see when they go and have their mortgage credit pulled. And even if it says FICO, that still doesn't mean it's the same. And I get, and I hear some people, they kind of hotty toddy, like, well, it says FICO. And I'm like, well, you know what? There's a lot of different FICO algorithms out there. I went and bought a truck in June. There's 4 different auto FICO algorithms. 4. Okay. So that's even more confusing. So when you go to buy a car, and they pull it up, they say, oh, you're this. Oh, but this bank doesn't like you because of this. So we're going to use this one. Oh, but this credit score is different over here because they use this algorithm. So it gets really even more confusing in the auto industry, in my opinion. But that's for people to understand, is that when you see just because it says FICO does not mean it's the law of the land. Okay. Now, when you see um, when you see your score like through Credit Karma, it's going to be used something that is called Vantage. Okay, now what is Vantage? Where did Vantage come from? Vantage came when the 3 credit bureaus got together and they said, you know what, we're going to do things differently. We're going to come up with a different algorithm besides FICO. And it didn't go so well because they ended up getting sued by FICO. Now they did all the research and they did everything to come up with a Vantage model. So it's still used today, but it's primarily a consumer-based algorithm. It is not an algorithm that's used in any lending decision. So it's Credit Karma, Identity IQ, a lot of other places will use a Vantage score, which is actually very similar to, say, a FICO 8 score, which is FICO's version of a consumer-based credit score. Okay. Are there any questions about that piece before we move on to the mortgage FICO scoring model? We're all good. Everybody
We
can
really
see.
get a lot of questions. Yeah, I mean, when we're talking with clients, a lot of times they ask, well, why can't I see my mortgage score? Why can't I just dial it up on the internet like I can everything else? And that's a really hard thing to understand too. That those mortgage algorithms are proprietary to loan officers that can interpret them and apply them to lending. So it's hard, it's a hard thing, and it's one of those no's that we just have. Like, we can't. Now, if you go on myfico.com, we have heard that there are mortgage algorithms in myfico that you can see. So if you subscribe to myfico, there are some older mortgage algorithms that are in there, and we hear that they're kind of close to a mortgage pull, but they're still not the 3 that Owen would use in his mortgage pull. So the answer is you really need to talk to a loan officer.
All right, Susan, you want to pick up on this?
I think what we're going to do next. Yeah. So this is a breakdown of what is in a mortgage FICO credit score. Okay, these 5 sections are what makes up the algorithm, like we talked about, computing a mortgage FICO score. There's payment history, amounts owed, length of history, types of credit, and new credit. Okay, so let's talk about this first section here, payment history. So 35% of your score is made up of everything that you're currently making payments on. All of your credit cards, all of your installment accounts, everything that, that's open and active, okay? But also in this 35% is everything that's negative. So any late payment, collection, charge off, repo, bankruptcy, inquiry, all of that is, not inquiry, sorry, but all of those negative things are in this 35% section. It's really important to understand months of review. So a month of review on an account is a month where you've had like activity, and that activity is what helps that account to continue to be present in this 35% section. So like for an installment loan, like a car loan, every month you're making a payment. So that month of review number gets greater and greater and greater and greater. Or if you've got a 10-year student loan, you're going to have 120 months of review by the time you get done paying for that, right? So those trade lines with lots of months of review benefit your score even greater every time that month of review gets larger. And for that matter, then a credit card that you use sometimes and sometimes you don't may or may not be increasing that month of review. So that's why it is recommended on a revolving account where, kind of charging is optional, right, is to have some kind of activity, sparingly every month, but regularly, right? And that's our recommendation about credit card usage overall, right? Sparingly, but regularly. And that regular use of that credit card helps to increase that month of review. So notice at the very beginning of this, I said open and active accounts are calculated here. So if you have a car loan and you did that great thing and you made that last car payment, right? That's a great feeling. It's a great financial accomplishment, right? But very often what happens is your credit score goes down as a result. And that's because when you pay off that installment loan, all of that payment history drops out of this 35% section. And that's why Owen's going to tell you, or tell your borrowers, like, don't pay off that loan, early, because it'll drop your score. And that's why. It's because all of that activity, it kind of goes into this historical part of your credit report, but it's not figuring in this open active part of your score any longer.
So the amounts
Yep.
owed section here is we're talking about revolving. And let me explain quickly the difference between revolving and installment. Just, Susan really just kind of went over installment loans, but that's where you're making payments regularly on something. You buy a car for $50,000 and then you make, or $30,000, you make $500 monthly payments for 60 months and, you pay it off, right? But you can't borrow back against an installment loan. If you need a set of tires when you're halfway paying off that car, you can't just say, oh, well, I'll just use some of this available credit that I have. No, it doesn't really work like that on installment loans. It does work like that on revolving loans, right? So if you have $1,000 credit card and you buy a set of tires for $900, well, you're utilizing 90% of that. But if you pay it down to $300, you're utilizing $300, okay? And you can always borrow back against it. You need, to go buy, get some gas for $100. Well, you just go charge back on it. We all know how credit cards works, and it's because it's a revolving door. That's why it works that way. But it's called utilization, and that's basically the limit versus the balance. The higher the utilization, the less points you're going to earn towards your credit score. The lower the utilization, the more points you're going to earn towards your credit score. Now, I think a big misnomer here is that I'll ask people, hey, what's negative on your credit report? And one of the first things they'll talk about is like, oh, well, my credit card's nearly maxed out. Well, it's technically not a negative. It just really means that you're not earning as many points on that card that you could potentially be earning. The reason why that's important, because when we go through things like credit coaching, one of the things we're going to look at, and we'll talk here about credit history in a second, is well, which card is higher value? So if we're going to have you pay down on a card, we're going to look and like, well, which one is going to give you the biggest bang for your buck if you're going to pay it down? Is it going to be that card you opened up, 8 months ago to buy some furniture and now it's maxed out? Or is it going to be that card that is also maxed out that's 15 years old? Well, that 15-year-old card might be have a higher value. So by paying it down, more earns you more points. That's why it's an important distinction to know that every card is going to earn you this, and then it's a percentage of this based on the utilization. Okay. Now, you do also get penalized for being over the limit on their credit card. So if you have a $300 limit credit card and for some reason you let it get up to $350, well, you are going to get penalized for being over the limit. And we see that quite a bit when you have people whose credit scores are in dire straits. It might be because they have several cards that are over the limit. And, like at first glance, you might look at them like, why is their credit score in the 400s? Oh, that's because these 4 credit cards are over the limit. That's, a big thing, also that with the collections, but, those are the things that bring in their credit score down. So that would be a negative because you're getting penalized above and beyond. Not only are you not earning points for that card, but then you're getting a negative hit on top of it. Okay. Now, the one thing I always like to point out here, if you don't have an open and active credit card, you do not earn any points in this section. So, and we're going to talk a little bit later on about building credit after the break. But we'll come back and kind of talk about this section. But the biggest takeaway here is going to be understanding utilization. And one thing that we do with our credit coaching is we put together a game plan for them to help them understand what dollar amounts they need to pay down in order to help get their credit scores up. Now, something that I'm sure Owen probably does as well is he probably goes through, if he gets a buyer and hey, they need 5 points, and he sees that, oh, you've got this Kohl's card that's $300 and you have $290 on there. Well, go pay $200 on it, call Kohl's up, get a letter stating the new balance, and give it to me. And I'm sure Owen can probably take it from there. Owen, is that something you usually do?
Yeah, so we have that rapid rescore available through our credit provider that allows us to do that kind of stuff.
Perfect. Yeah. So yeah, and those are things that are pretty simple. But if you're needing more than 5 points, that's when people usually come to us and we put together that plan for them. So we'll let Susan talk here a little bit about length of history.
So 15% of your credit score is a straight up average of all of the length of history of your open and active trade lines. So everything, installment and revolving, that's open and active gets averaged out, and then that is what fills up this 15% section. So in order to max that out, you have to have 25 years of average credit history. That's a lot, right? So you don't pay on a car for 25 years. You don't pay on a student loan for 25 years. You might pay on your house for 25 years or more, but sometimes the trade line that could get to that maxed out, 25 plus is more than likely a credit card, right? And the people that we see that have 800 plus, uber high credit scores are folks that have trade lines like an American Express card or a Sears card or a BP gas card they've had open since the 80s, right? And that help them to really maximize that 25 years of average credit history. So now, we get asked all the time about closing accounts. Like, does it, well, I thought it hurt to close down an account. The answer is maybe, right? It's all about the average, okay? So if we have someone that that we think that maybe their length of history average is diluted because they've got a bunch of store cards that they really aren't using, that are kind of brand new, maybe they just bought them for the coupon and then they paid them off and let them sit there, maybe we would even look at closing some of those newer, younger accounts to help build back that average. Or you can, I don't want to say manipulate, but really that ends up happening when you get added as an authorized user on a credit card. So you guys are all familiar with what an authorized user is in the world of credit cards? Maybe. So yeah, some people are saying yeah. So an authorized user is someone that you grant access to that credit card. They are not financially responsible and their credit is not used in that lending decision, okay? But they are able to use the account, and the activity and the payment history, all of that reflects over onto that person's credit report, okay? So parents do this a lot for their kids so that they can generate a little bit of a score and then use that score to help get their own credit, established in their name. And it can happen in, husband and wife. And I've got a realtor that I'm helping with some credit issues right now, and she had her dad add her to one of his credit cards, and it's really helping her build back her credit. So it is something that can be used to help kind of fill up this part of the length of history, right? This is also where we like to talk a little bit about how many accounts you have open. So if you have kind of a thin credit profile, let's say you've got one credit card and one installment loan, you don't really have a lot going on there, that kind of puts you at risk for any time that you open new credit, you're really going to dilute that length of history average. But if you've got a few accounts open, let's say 3 credit cards and 1 or 2 installment loans that you've been working on and making payments on for a while, then when you need to open new credit and you add that 0 to the average, it's not going to affect it as much as if you were that brand new credit user and you just have 1 or 2 accounts, okay? So a thicker file is going to see less fluctuations in the length of history than, when you're accessing new credit than a thin file, okay? Did I cover all that, Chris?
All right. Let's move on. I'm going to talk about the next 2 sections here, and then we're going to take a little short break. The first one is types of credit used. So really, we're going to be looking at, what type of credit do you have on your credit report, and that is an important fact. Things like even mortgages, can help, and sometimes you'll even see lack of mortgage account is, impacting your credit score. But the biggest thing that we really look for here when we're looking at our credit report is, well, do you have too much of a certain thing? Now, first off, let me back up a little bit. A good mix of credit is usually like 3 revolving accounts to 1 installment account. Okay. That it doesn't necessarily mean if you don't have an installment account, you need to go out and get one. I had a client that said, hey, Chris, should I go out and buy a car for my daughter? But he had, lots of older credit cards. I'm like, no, that's not necessarily going to help your credit score. Remember, we just talked about length of credit history. It's an average. So by opening up something like an installment loan, just to help you here in this section, might hurt you in another section. So things kind of work yin and yang in different parts of the pie here. So we always want to make sure that, we're doing the right thing. So we wouldn't necessarily need to open up an installment loan if you don't have one. Okay. But really, when we look at this section, if you have too much of a particular type of account, it can actually hurt you. So, for example, let's use store credit cards as an example. And the story that I always tell is had a client in Dallas. She had 25 store credit cards. And on the mortgage credit report, there was actually a reason code on there that said too many active retail accounts. And they were talking about the store credit cards. And when I asked her, I was like, "Oh, why do you have so many store credit cards? Let me guess. You live near the Galleria in Dallas, obviously. And being a Houstonian, I like making fun of people from Dallas. So I goaded her a little bit on it, and we had a little laugh. And she's like, "Well, yeah, I do live near the Galleria." But I guess it could be the same thing if you live near the Galleria in Houston too. You could have lots of cards. I think the Galleria in Houston's bigger than the one in Dallas, anyways. So but that said, so we talked about a plan with her to actually close down some of those cards, ones that she really didn't. I mean, let's be honest, she didn't need any of them. But let's for the sake of your credit score, let's go through and whittle some of these down to help alleviate that part of the section, which was having too many retail accounts. And the next section here is new credit. So two things that can impact your score here is first off, anytime you open up a new loan, any kind of loan, you're going to lose points initially for opening up that new account. The reason for that is the highest rate of default for any type of loan, mortgage, auto loan, credit cards, happens within the first 90 days. So they're going to hit you with that. Is kind of just a buffer for showing that you're at risk. And that's what the whole point of a credit score is to show your risk of not repaying the loan, right? So when you're in that risk period of that first 90 days of opening up a new loan, your score is going to come down. And it could be anywhere between 5 points to sometimes I've seen it as high as 30 or 40 points. But you get those points back once you've established payment history with the credit bureaus, with that creditor. You're going to get those points back. Okay. The other thing here that impacts you in this section is inquiries, and I would say it's probably one of the most misunderstood things in the mortgage industry is an inquiry and how it impacts your credit score. But let me back up real quick and just tell you something about inquiries. You have hard and you have soft inquiries, okay? A hard inquiry is when you're applying for money or credit. Like if you go and apply for a home loan through Owen, that's going to be a hard inquiry, okay? Now, there might be some soft inquiries that happen during the process, but the initial application has to be a hard inquiry. When you apply for a car loan, it's going to be a hard inquiry, okay? Soft inquiries are review pulls. So if your current creditor wants to give you an increase in your limit or just review your credit in general, they can do a review pull, and there's no negative impact to your credit score. The other soft pulls that would be included in that would be anything like an online. So if you go to Credit Karma, Identity IQ, or any MyFICO, whoever, and some online place, those are all soft inquiries. There's no negative impact to your credit score. Okay. Now, here's where the confusing part comes into, and I think where things get really misunderstood in the mortgage industry in regards to inquiries is shopping windows. Do they exist? Do they not exist? There are some people out there will say, well, shopping windows don't exist. And I wholeheartedly, not just do I don't disagree with them, I know that they are 100% wrong. Okay. Shopping windows do exist. It's how they are applied where people think that they don't exist and that they're a myth. But it says but FICO actually states that there are shopping windows, but how inquiries get counted in a shopping window is based on the actual coding of the inquiry itself. So when Owen pulls a credit report, most likely it's going to show on there real estate or home. Okay. When you go to buy a car, it should show up as auto. Okay. I said should. Remember, I kind of threw that out there. But what happens, and let me kind of just tell you a story, and it will really illustrate how this happens. Is I had a loan officer come to me, and a mortgage loan officer, and said, "Hey, Chris, can you tell me why my client's score dropped 35 points? All he did was went and bought one car from one car dealership, financed through one company, and his score dropped 35 points. And the loan itself was not showing up on the new credit report. And he had both credit reports side by side when he showed them to me. And then when I looked at the new credit report, the only thing that was on there were 14 new inquiries that came from him buying his car. So what happened when he did that, they did a blast and cast, a shotgun, whatever you want to call it, out there to see, well, hey, let's see, let's try to get this guy the best rate possible. Okay. But he was told, like, oh, this is going to happen. Don't worry about it. There are shopping windows and you'll be protected. So he probably went away thinking, oh, shopping windows are a myth. Well, they're still not a myth. But what happened was, of those 14, 10 of them showed up as financial. Now, the things that count into a shopping window are going to be things like auto, mortgage, and educational. Financial, which is like credit cards and any other kind of financial type of loan, do not have a shopping window. So if I go to the mall and apply at 25 different stores, I'm going to get 25 hits against my credit report, okay? Because that's a high risk, okay? So credit cards and things like that do not have a shopping window, okay? So what happened when stuff got sent over to the bureaus, of those 14, 4 of them showed up as auto, the other 10 showed up as financial. So he technically had 11 inquiries impacting his credit score from buying one vehicle. Now, on average, an inquiry is going to impact your score about 3 to 5 points. So the fact that his scores went down 35 points was a little over an average of 3, right? 3 point, whatever that is. So that's how his credit score dropped. And I've seen that in countless cases, not just that story that I tell, where people have shopped and they see a drop in their score because of that. Oh, and did you have something to add to that?
Yeah. So, well, not to add, but I have a question, because I get, you're right. It's the number one thing that people are worried about, having too many pulls on their credit. So what in the following scenario would the person's score drop if they have 3 different mortgage companies pull their credit within 15 days? Should the third credit pull be the same as the first?
If they all are reporting and being recorded as home or real estate, then the answer is yes, they will all count as one. Typically, the shopping window is 45 days.
Okay, so then I have another question. So if company A pulls credit, mortgage credit on day 1, and then on day 46, company 2 pulls credit, should the scores be the same, assuming everything else is equal? Or does that?
No, because you're going to have that first inquiry is going to be impacting them, because usually there's a 30-day buffer from when the inquiry happens. So, you have the inquiry, 30 days later is when it actually impacts the credit score, so that if you're pulling it day 46, you would actually see a hit you would see that first, inquiry A on the credit report, bringing the scores down 3 to 5 points. So you would probably see a difference if theoretically, if everything else is the same, but as we kind of talked about that's usually not the case, because especially if they have credit cards, but theoretically, it would bring it down by just that inquiry. So yeah.
Okay, good, thanks.
Yeah. Any other questions? I think there's a couple questions that popped up. Nope, I don't think so. So
I have a question.
Yeah.
How much does 3 or 5 points affect your credit score?
3 to 5 points.
Because you were alluding to the fact that the more people that pull up your credit, it could it could vary, or it could be different from 3 to 5 points.
Yeah. So I mean, 3 to 5 points is 3 to 5 points, but I think maybe what you're trying to ask is, what constitutes the variance between the two. And what you're going to see is those people that have more established credit and more credit history are going to be impacted less by an inquiry. Okay. And that's by design, because you're at a lower risk. You have a mortgage loan, you've got 4 or 5 credit cards that have got 10 plus years of credit history. So there's a lot of factors that go into that. It's usually those people that are newer or have very little credit, or even sometimes no credit, that get hit the worst and the hardest. So if you have somebody that goes out and has no active trade lines and only a bunch of collections and a 546 credit score, and they go around to 20 different car dealerships trying to buy a car and getting the best rate for it, they're going to get hit pretty hard. And I've seen people like that, their scores drop down 100 points because of it, because they're really going out and shopping because they got bad credit to begin with. That is built into the model, the credit model, to show that you are now at a high risk. But if you're, you're in your mid 40s and you've got credit cards that have been opened up for 20 years, you got like 3 of those, suckers, and you've got a couple car loans and a student loan, and all these things on there, and then you go to buy a mortgage, applying for one mortgage loan may only hurt your score a couple points, that inquiry. So it's not going to bring you down that much. It's usually those people that need the points, those are the ones that get hurt the worst. So with that, we're going to take a little short break. It's a Trek mandated break that we have to take here. So let's, right now it's 1:03. So why don't we plan to come back at like 10 after? Okay.
All right. Thanks.
Okay.
Hello. Hey, Chris.
Yes.
Can you hear me?
Yeah, I can hear you.
Hey, I'm gonna pop off, and I just wanted to let you know before I did that.
Okay.
Okay. But thank you.
Yes.
Thank you for doing this, and
All right.
everything seems to be going well.
All right. Thanks, Laura. Yeah, if there's any questions or any follow-up, just let me know, and we'll get you over a list of everybody that will call.
Chris.
Yeah.
Oh, I appreciate it.
Hey, it's
Thank you,
Lori.
guys.
Hi.
Hey, Lori,
Hi.
how are you?
Good. I just wanted to let you know I'm not sleeping
Oh,
because
you're
I'm
fine.
laying down. I've had foot surgery, so I'm laying down.
You're
I
fine.
just didn't want you guys to think I'm sleeping.
No, you're fine. I think it's like
No.
my son on his Zoom calls for his classes. Sometimes he'll do his class while laying down on the carpet. So
I just wanted to make that clear. I promise I'm not sleeping.
No, it's fine. Even if you were, that would be
you.
fine. So, all right.
No.
I'll see you back in about 5 minutes.
Okay.
Bye, Lori.
Well, we'll get started. Can everybody hear me okay? Okay. But before we get started, I don't see anybody that's, except for Owen. I appreciate that, Owen, but go out and give us a like on our Facebook page. We do have, a gift card that we're going to be giving away for 10 bucks in that likes raffle. And then also there's a lot of information that we share on our Facebook page, future classes. We're actually working right now on some other classes that we'll be doing and introducing to everybody. So as those things come about, we'll be putting that information out on our Facebook page. So please go give us a like. We'd really appreciate it. And then also we like to push out lots of good information. All right. So with that,
can you give me the Facebook page name again?
it's just facebook.com/elevatemyscores, or if you just go to Facebook,
Elevate My Scores.
Elevate My Scores with an S.
Got it.
Yeah. All right, so we're going to let Susan talk here a little bit about building credit. And then again, if you said, like we said, if you have any questions, feel free to put them in the chat bar.
Okay, hey everybody. So let's talk about building credit. This is like for somebody brand new, building credit for the first time or rebuilding credit after, a period where they had some issues. So when we talked about the types of credit earlier, Chris mentioned that the ideal picture is 3 revolving accounts and 1 installment account. That's what is the ideal picture of your credit profile. But if you're starting from, restarting or starting from nothing, how do you get all of that credit, right? You just don't, snap your fingers. You've got to have the score that qualifies for you for that. So one of the things that we recommend very often is a secured credit card, okay? So a secured credit card is a credit card that you open and you put down a security deposit of a few $100, and that is how then they issue you a credit card equal to the amount of that security deposit, okay? Now it's not a prepaid card. And we've even had somebody get that confused with a prepaid card before, not that kind. But it truly is a security deposit. So then you spend and you make your payments just like a regular credit card. It reports to your credit report. It does say secured, but it doesn't change the outcome of how it affects your credit score. So it's a good way to get started. Now, what you should know about secured credit cards is that banks and some lending institutions will check your credit. So there are some folks that, that if they go down to their bank or their credit union and they apply for a secured credit card, they may not get approved. So then what do you do, right? So that's why we recommend this starter card called Open Sky Visa. And if you Google Open Sky Visa, you'll find their webpage. I believe the URL is just openskycc.com. You should go enter that in your browser right now and just take a look at it. But the great thing about Open Sky Visa is they don't pull credit. So you can get approved for a secured credit card with a source of income and a bank account. And they're going to verify that, but then they'll issue you a credit card based on that information. So it's a great way to get started. The other good things about Open Sky Visa, like I said, no hard inquiry. So there's no drop in score there, right? And it reports to all 3 credit bureaus, really important. There are some types of secured cards that don't report across all the bureaus. So for someone that's really wanting to build their credit, that's a big feature. It's going to give them that information. And if you have someone that has no credit card and they're missing out on all of that good payment history and utilization, amounts owed, portions of the credit score, you want that to go out to all 3 bureaus to help boost their scores, right? then usually if someone gets a secured card like Open Sky Visa and they open it and use it for a couple of months, they start generating a score and moving their score up to the point where then they could qualify for one of those secured cards like at the bank. Or we also like to tell people about how Capital One, they have a secured card product that you get started with, and they do check your credit. See, there's a minimum threshold there. But after a certain number of months of on-time payments, then they graduate you out of that secured card and into an unsecured credit card and refund the security deposit. So that's a pretty good one, like for step 2. Installment loans are a great way to build credit as well. For that matter, a student loan could potentially be something that would really help build a young person's credit if borrowed responsibly and paid back responsibly, because you're going to be paying on them, you know, steady as she goes for such a long time, right? There are some starter installment loans like self-lender, which is kind of a good way to sort of borrow your own money and create some installment history. An auto loan, other types of personal loans. Now, not the payday loans that where you go down every 6 months and get a new one, because those are usually cyclical and can have a real negative impact. In fact, there are even, you know, drops to your score that can happen from doing too many of those payday type loans, those note loans or float loans, even if you pay them on time. So don't necessarily, are not recommending that. 2 other ways to build credit that are really good are rental self-reporting and utility self-reporting. So rent self-reporting is where if you're renting in an apartment complex or through a property management company, this service called Rock the Score will capture those payments and then report them to TransUnion and Equifax only as an open active trade line. Okay, so it's a great way for someone who's been a faithful apartment renter or, you know, renting a house or whatever, to use that as a trade line to help boost their scores. Rock the Score is a paid service. There's a small monthly fee. When I say small, like less than $10. During the break, I did email the PDF packet to everybody that registered with the email address that you registered. So in the packet, there is a link to Rock the Score if you want that information and to check it out. Or feel free to contact Chris or myself and we'll be happy to share that with you as well. Then there's also utility self-reporting. This is Experian Boost. Anybody seen the commercials for Experian Boost? The guy says, hey, I raised my credit score 24 points, just like that, right? So the tricky part of that is that Experian Boost helps to boost your Experian score only, not the other 2 bureaus, okay? So that utility self-reporting only goes to Experian. And what they do, it's free. You sign up on their website and they scan your bank account for utility payments, telecom, utility. So you could have a few on there and it reports to Experian. It could be something that could potentially be an underwriting issue though. So we hesitate to recommend it because we've actually had a couple of loan officers say, yeah, well, that Experian Boost, we had to actually get it removed in order to help get our client qualified. So it's not something that we just say, yeah, that's a great thing to help everybody. Would really want to only recommend it on a case-by-case basis for that matter. Just because we've heard that it could cause some DTI issues in some cases for people that are kind of on the bubble. So whereas rent reporting, because they're already looking at your rent and your housing expenditures, doesn't have that same effect. Am I right about that, Owen?
Yeah, although I think we don't count those utility payments. So maybe some lenders do, or maybe there's some programs where they do count them, but we aren't supposed to count them. So I've been recommending people do that.
Good. All right. I'm glad it's working for you and your clients. So, okay. Well, let's move on.
All right. So credit monitoring, the FCC did a study and they found that 7 out of 10 credit reports have some sort of detrimental error. So the point here really is that it's very important to monitor your credit and what's going on there, because we see things all the time of people that say, well, this isn't accurate, or this isn't mine, or something on there that's, impacting their credit score. Little story about this is I had a client, she had a foreclosure, and it was a legitimate foreclosure. And as you know, that you can't purchase, I think it's within 3 years of the foreclosure, but the date that was being reported on the foreclosure was inaccurate. The foreclosure itself was not. But so even though her credit scores qualified her, she could not get the loan done because the date was inaccurate. So, but then, we challenged it. And not only did we get the date removed, we ended up getting the foreclosure completely removed from the credit report. But that's an example of just something that's not the item itself. The item itself was legitimate, but how it was reporting to the credit bureaus was a detrimental error in keeping the client from qualifying for the home loan as a result of that date. Um, so because of that, it's very important to always kind of monitor your credit and see what's going on there. And I think a lot of more Americans over the past decade, since, plus that I've been doing this, are doing just that. They're monitoring their credit scores. They're continuing to see what's on. And I think so many people have, 2 or 3 different places that they monitor their scores. And credit cards and banks often include, credit score monitoring as part of that. And I've even seen, like, my GM Financial, it says when I go in to make my payment, click here for your credit score. When we go in to pay our mortgage, it says click here to view your credit score. So many places are linking to sites to help monitor your credit score. Now, back to what we said before at the very beginning, you just have to know what you're looking at. Okay. Now, the one that we recommend is Identity IQ. And one of the reasons, and it is a Vantage score, but one of the reasons why we recommend them is for the price that you pay, the fact that you can refresh and see all 3 credit scores every 35 days is an advantage over some of the other ones. Like, Credit Karma only shows you 2. There's a lot of information that Credit Karma doesn't show you on the credit report. But then with Identity IQ, you're actually also paying for $1 million of identity theft insurance. So if something happens to your credit score, you can go back in and actually recoup some of the money that you've lost as a result of your identity being stolen. So identity theft and fraud, the different types of identity theft. You have mail theft, dumpster diving, shoulder surfing, skimmers, breaches, phishing, pretexting, ransomware, wire fraud. Like mail theft and dumpster diving are kind of 2 of the same thing. It's basically somebody looking for information about you personally in order to, try to steal your identity. Maybe it's just simple things like your a name, a phone number, an address, or maybe they hit, gold and they get a social security number, something like that. Phishing, I think phishing is probably one of the worst things here, and it happens all the time. They're phishing for information out there. They send you some kind of thing that looks real. It looks like Google. It looks like Twitter, which I think that's why it's so important to always have, and it's a pain, but to always have, 2-step verification turned on for everything, so that that if you're getting into Facebook and it's something on a computer that you're not being used, you might have to have a code sent to your phone, but it's better than having your account hacked. So if you do accidentally put that in there, the hacker will have no way of getting into your account because you'll have that 2-step verification turned on. Pretexting, and this one can be kind of scary. It's that they're using some information about you, or maybe assuming about you, in order to get more information, or maybe even to get money out of you. A story that Susan and I always tell is that our mom got a call from somebody that said, hey, Grandma, I'm in trouble. I'm in jail. I need some money. And she's like, is this Robbie? And she was like, yeah. And I'm like, well, of course, my mom didn't, the person didn't say their name, but then she was very fishy about it, hung up, and then called Susan and found out that it wasn't, Susan's son, Robbie, who was in college at the time. So those are but it was, trying to get money from, my mom. And this happens all over, especially with seniors. So, um, uh, shoulder surfing is just quite simply people looking over your shoulder. Probably doesn't happen quite as much now because if people are too close, you're like, hey, 6 feet, so you're usually pretty good there. But before COVID, shoulder surfing definitely was something where people are watching right behind you as you're putting your pin in when you're at HEB or something. But ransomware and wire fraud, these are things that, are very huge, especially ransomware right now. People are on their computers a lot, doing a lot more on their computers. They download something, it locks up their computer, especially if you have a PC. And then the only way you can get it back is if you send them some Bitcoin money, right? Like, oh, here, send us $500 Bitcoin and we'll unlock your PC. And if you use it for work, well, you might think like, okay, spending $500 to get my computer back might not be that bad. But in the real estate industry, wire fraud is huge. I get phishing emails that are related to wire fraud all the time. I'm sure you guys do too. Like closing docs included, click on here to approve. It's a phishing email it's all tied to wire fraud, and they think that maybe I'm a title company or something. But if the wrong email gets put in a wire transfer, that can be a problem, and it's happened. And then skimmers are usually in relation to like gas stations, stuff like that. And especially now, you're not usually going inside the store to pay, you're paying there at the pump, and that could be a problem too. So people are trying to skim that credit card number from you at the actual pump itself. And then breaches is, before we had all these other problems, it seemed like they were happening all the time where different companies were getting breached and information was getting stolen. And of course, if that information gets stolen, it can be used and sold out there on the dark web. Susan, you want to take identity errors?
So as much as we get upset about that fraud and the theft, errors are way more common on a credit report, like when Chris was talking about how important it is to monitor your credit. So some of the common errors happen with a common last name like Jones, Johnson, Martinez, Lopez, that live in a highly populated zip code. And just statistically, things show up on your credit report that don't belong. We had a client named Ruben Garcia who lived in a big, highly populated area. He had a ton of stuff that he just couldn't, fathom where it came from. And it was just, like I said, that statistical error of his common name with the big area that he lived in. And for that same reason, then juniors and seniors and really similar family names can have a lot of cross-reporting that has to be sorted out for years and years and years, and they have to really be vigilant about that pretty much all the time. Now, the one thing that is just an odd sort of identity error happens when you have 4 letters in your name that match with 7 out of 9 social security digits, okay? And then what actually happens is the credit reports merge. And Chris and I have kind of been on the front lines of even, discovering this and trying to figure out, if this is indeed what we are looking at here. And I remember a phone call earlier this year where I had this credit report that was for a client that we were working on, and I really felt like that's what we were seeing here was this social security mismatch. And Chris and I did some sleuthing and were able to figure out that was indeed what had happened. But Chris has a funny story. I like the way he tells it, so I'm gonna let him tell it about Roberto and Robert, a sad tale.
Yeah, so the sad tale of Roberto and Robert. This is an Aesop's fable, goes way back thousands of years. No, I'm just kidding. So I had a client, Roberto. He's like, "Oh, my identity's been stolen. This guy by the name of Robert stole my credit, my identity, and opened up all this stuff in my name." I was like, "Okay, let's go through the credit report. Tell me what's not yours." And he started telling me things. Things were a lot of collections, and one of them that stood out happened to be a Chase credit card. It had been opened up for 7 years and had a $3,500 limit, about a $500 balance, never missed a payment. So I was like, okay, so let me get this straight. Robert stole your identity. He's like, yeah. He opened up this credit card, this Chase credit card for $3,500 limit. Yeah. He's made the payments himself on time for the past 7 years. Yeah. Well, I guess Robert's the most honest thief ever, because thieves normally don't do that. But I knew the answer before I even asked him the question. Sometimes you have to kind of go through things to get people to understand the point of it. And it turns out, poor Robert did not steal Roberto's identity. It was because 8 out of the 9 social security numbers matched, and it was only one digit that was off. And since they have pretty much the same first name, they had cross reporting on the credit report. So now we were able to get that fixed, but and oh, by the way, that Chase credit card that he had opened up for 7 years was his best trade line. So we left that one alone, because it would have dropped his credit scores quite significantly had we removed it. Now, I'll let the underwriters figure that part out if it becomes an issue there. But as far as his credit score, it definitely was by far his best trade line. But the point here really is when you look at something, a lot of times it's not always this malicious act. Sometimes it's just errors that are related to their identity, related to a social security number, related to a zip code, last name, juniors and seniors. All those things can be things that are on their credit report and bringing the scores down. Now, what kind of negative items can impact the credit score negatively? Collections, late payments, charge-off, bankruptcies, inquiries, medicals, repos, short sales, foreclosures, tax liens, profit and loss, divorce-related issues. Let me talk real quick on tax liens and judgments. This is something that's changed over the past probably 2 years. You usually don't see tax liens and judgments reporting on the credit reports anymore. Now, a loan officer might still see it on the credit report that they pull, but it's not part of the actual bureau information that gets pulled over. The reason for that is there was so many errors that were and I saw them all the time in relation to tax liens and judgments. You would see things on the credit report that just flat out were wrong. So they tightened up the way things get reported, and basically it meant that they just stopped reporting to the bureaus, liens and judgments. But of course, liens and judgments are still pretty important when it comes to the underwriting of a loan. And so now mortgage companies, the bureaus that they're pulling through, the actual credit reporting companies that pull that credit report information, are using a LexisNexis search of the public database to actually pull that information back on there. So I think it shows up as like LXN or something like that on their credit report when it shows a judgment or a lien. And it usually doesn't impact the credit score, but it sure as heck can impact the underwriting of the loan. Because if you have a tax lien, you're not getting a loan. If you have a judgment, you're not getting a loan. It's just you need to get that taken care of. So that's one thing I kind of want to point out there about negative items, about liens and judgments. Now, bankruptcies, we usually still see reported to the credit bureaus, but as far as liens and judgments, we do not, and they usually will not end up hurting the credit score, but they can certainly keep you from getting something like a mortgage loan. So now let's talk a little bit about collections, type of collections. Credit card, utility phone, student loan, housing, medical. It seems like almost everybody's got at least one medical collection on their credit report. They're so common. And mistakes are made all the time in medical billing. So I'm actually surprised there's not more than what we see, but we see a lot of medical collections, on the credit report. Um, and but the truth of it is, for what we do, it's actually one of the easier ones to get removed from the credit report. But the biggest thing that we want to talk about here is understanding what to do when you have a collection on there. Should you pay it? Should you not pay it? So the one thing to understand is new versus old collections, paid versus unpaid collections. So there's some simple truths I tell all of my clients and anyone that will listen about collections. First thing is, paying a collection will not remove it from the credit report. Okay. Number two, paying a collection in most cases will not help your credit score. Number three, paying a collection in some cases can actually hurt your credit score. Now, why in heck would paying something that I owe negatively impact my credit score? And that's because the date of last activity, and that determines how old the collection is. The older the collection is, or really the older any negative item is, the less it impacts your credit score. The newer the negative item is, the more it impacts your credit score. So once you have a collection that hits, as it ages, it's going to go down like this as far as the impact on the score. But if you make a payment on it, like pay it off, what have you done? You've renewed the activity. So what happens? It goes back up to the top. It now becomes like a new collection. Now, even though it shows a zero balance on that medical collection, it's going to negatively impact your score. And the sad tale that I tell on this one is, I had a client call me up and she was in tears. She had a home picked out. She was a single mom, 3 girls, found the home of her dream, had the earnest money put down on the deal and everything. And then she got a call from a medical collection agency that said, you can't close on this home loan unless you pay this medical bill. They won't let you close on this loan with medical bills. She was like, really? Okay, well then let me pay it. And they're like, but because I'm such a nice guy, instead of paying $800 that you owe us, we're only going to charge you $400. Oh, thank you so much. Let's pay it. And then what happened is it reported to the credit bureaus as a zero balance, because she was like, I need you to report it as a zero if that's the case. Well, of course, the collection agency lied to her. Medical collections don't impact the underwriting of a loan. If your score is where it needs to be, the fact that you have a medical collection on there, they don't care. Okay. They just care about the score. So she was lied to, taken advantage of. But what happened was, when she paid it, she renewed the date of last activity on it. It dropped her score 50 points. She ended up losing the home that she wanted. Okay. The home that she told her girls, like, hey, this is the home that you're going to be living in. Okay. She lost that home as a result. Now, I helped her get it fixed as quickly as the law allows to do that. And then she, ended up finding another home. So there's a, happy ending to the story. But I think that's one of the other things I think you can take away and give to your clients is, if clients say like, well, I'm going to go pay off a bunch of stuff first before I go talk to Owen and have him pull my credit report. You need to go, whoa, what do you plan on paying off? And if they say like, oh, I'm going to pay down my credit cards, like, okay. If but if they say, oh, I got all these old medical collections from this, when I broke my ankle 4 years ago, I'm just going to go pay those off and we'll be good to go. Whoa, no. Once that collection hits, the damage is done. Okay, so talk to a professional. Get them over to Owen. Okay, have Owen take a look at it and make that determination. Well, is this something that we can work with, or is it something where they need some more help? And then they come to us and then we talk to them about it. Well, what can be done on it? Okay. Now, there are times where paying a collection can help. Now, the biggest example of when you pay a collection that it helps is with a credit card collection. Now, why is a credit card collection different than a medical collection? Well, in some cases, credit card companies will hold on to the original collection, and it's called a profit and loss, versus a charge off where they charge the dollar amount, they show it as zero on the credit report, and they sell it to a collection agency like, say, LVNV Funding. Okay. Well, in that case, you see two items on your credit report. One shows zero with, Capital One, and the other one shows LVNV Funding, original creditor Capital One. Well, paying that collection doesn't help, but it's the one where, let's say it's First Premier, and First Premier will typically hold on to that debt. They may have a third party collection agency try to collect the debt, but on the credit report, it'll say $450 balance, $300 limit. And that's the important piece right there, because it shows the original trade line. Going back to that utilization that we talked about, if you have a $300 limit and a $450 balance, you're 150% utilized on that card. Remember, we talked about what happens when you're overutilized on a credit card? You get penalized, right? So on this card, even though it shows as profit and loss collection, it still shows up as 150% utilization in that 30% section. Okay. So in that case, by actually settling, in a lot of cases, you can settle it for less than the full amount, and paying that credit card off and showing it as zero, it will take away that 150% utilization, go down to zero, and your credit scores go up as a result. Now, and also in many cases for what we're doing, which we're investigating the negative items to try to get the items removed from the credit report, it actually helps our investigations, because now that they got their money, a lot of times they don't care and it comes off the credit report. But these are the things that we work with. And I'm not saying, hey, I'm teaching all this so you can kind of explain these tips and tricks to your clients, because sometimes, you don't want to, you want to have a professional look at it. It's like, oh, hey, I just learned how to rebuild an engine. I'm going to go out there and rebuild the engine in my, 2019 Ford F-150. No, you're probably going to break something. You're not a mechanic. So you really need to have a professional like Owen or ourselves look at it and see what's the best course of action. But just to know that there are certain collections that you can pay, and there are certain collections that if you pay, it will hurt. Okay. And that's one of the bigger takeaways here that I want people to understand about this, because I think this is really where a big mistake is made by clients. When I hear, oh, I'm just going to go do this myself, I'm usually like, well, what are you going to do yourself? Well, I'm just going to go pay off my bills. Okay, what bills are you talking about? Well, those collections we just talked about, I'm going to go pay them off. I'm like, all right, well, you're still not getting home though. Well, why? Because your score's not going to go up. In fact, your score's going to go down. Well, why? And I go through my 3 main truths about collections to get them to understand. But if you guys are on the front lines, if you can explain this and say, you know what, hold off, talk to a professional first before you do anything. Okay. Owen, do you have anything to add on that in regards to collections and what you've seen?
No, not really, but I think that's true. I think some things to us seem so obvious that should improve our credit, but they aren't. And the other one, it seems like people, oh, I only have one credit card, I use it for everything, and I pay it off monthly, but it's usually maxed out. It's better to have 3 cards that you use 20% usage on versus one, just having one that you just load everything on. So
yeah, no, that's
you
great
would
advice.
think that the person with one credit card was a better risk, because they think that way, but not.
Yeah.
So
yeah, that's the thing about credit. It doesn't always make sense. Sometimes you have to kind of just play the game and work the algorithm rather than do what makes sense. So the next thing we want to talk about here is COVID-19. I mean, we're still talking about this. I mean, we started doing these online classes back in March now. I guess I knew we'd probably still be here, but sometimes it still seems unreal that we are still here. But at least when we started these classes in March, it felt like we couldn't even go to the grocery store and get gas, but now we can at least do those things, and kids are going back to school, so that's good. But let's kind of talk about the impacts that it's had in the industry, and we'll bring Owen here in a little bit. But one of the things that we first saw in credit repair was we were actually able to get a lot more deletions with what we do, which is, attacking the negative items. The creditors by law have 30 to 45 days to respond to our investigations. If they don't respond, or if they don't have the information on file, by law, it has to get removed per the Fair Credit Reporting Act. But recently, the CFPB, which is the Consumer Financial Protection Board, ruled in favor of creditors when it comes to FCRA investigations, where they're giving creditors now more time because they know that they're short-staffed to respond to these investigations. So it's, for a lot of credit repair companies, it's made it that much more difficult to get things off their credit report. But we do have a program that involves a legal team that actually goes after these items using a law firm that can attack these items with certified letters on, legal letterhead, using the Fair Credit Reporting Act and the Fair Debt Collection Practices Act, and then followed up on by those attorneys. So if the proper action per those FCRA and FDCPA are not followed, then our lawyers will actually follow up with a lawsuit. So not a lot of credit repair companies are going to that length to protect the client and their rights, and when it comes to the FCRA and the FDCPA. So we're able to kind of get past that CFPB, but a lot of other credit repair companies are not right now. So that's really kind of one of the big impacts that we've seen in credit repair. And with realtors, I know when we first started this class, it was, you can only do virtual showings, but I think from everything I've been told, you guys are back to being able to do it in person, but you have a lot of protocols and stuff that you have to go through when you do showings and stuff. And government stimulus, I think right now we're still kind of, on hold. There might be another government stimulus that will come out, and it could be something that, I think realtors really need to watch, because if another government stimulus does come out, it could be another addition to the PPP, which, can affect realtors, and that you can apply for PPP if it does come out. So, keep an eye on that. And then small businesses, I always, put this plug out there as a small business owner. Make sure to always go out and support your small businesses, especially your restaurants and bars and the best you can, and any other kind of small business out there that's not getting the business like they used to, because so many small businesses are closing every single day as a result of the pandemic. So, Owen, what are you seeing right now in the mortgage industry in regards to rates? I know we've been on a roller coaster ride with rates and everything. It seemed like at first they went low, then they went high. Now it seems they're low again. Where are we at today? And where do you think we're going to be going in regards to the COVID-19 impact?
Well, good question. Let me make my crystal ball. They're low, and it's and I think you all have figured that out. And the affordability of homes is better than it was a year ago. It's funny. I just had a little email conversation with somebody that has like a 660 credit score, and they're putting 5% down on a conventional loan, and I'm telling them that the rate's going to be 3.5%, and the response was, "That's outrageous," And it's like, well, you've got a 660 credit score, and those are we tier priced for if you were 750, you'd get the 2 7/8. Anyway, but just the fact that someone says 3.5 is outrageous in a negative way, it kind of floors me.
That's funny.
And so, so I'm always, whenever I'm quoting a rate, which I quote, and then I usually put a little parentheses and say, by the way, you have amazing timing. This is the best time to buy a home ever. Just look at that. It starts with a 2, So anyway, but yeah, so actually rates have kind of in the last week or two trickled up a little bit. I don't know. I think there's some nervousness about the election, whichever way. I don't know which way it would. Whoever wins, I can't imagine it's going to be a big impact on rates. But we have, the government's issued so much debt that it's got to be paid back eventually in some manner, and the more debt that gets issued, the more pressure on rates to rise. So I kind of think we're in for a little rising rate environment next year. But yeah, it's super low. I think there's still people buying homes. I guess initially when this happened, everything just fell off the cliff and everything shut down. There was a big drop in March, but then starting in April, things started ramping back up, and it's been a good year for us. So.
And how are there right now? I mean, outside of the rates, I mean, what kind of credit scoring requirements are you seeing for the different loan types?
Well, we don't have any overlays, so if we get an automated approval, we can do it. But you're right, the pricing, if the credit's in the 600, they aren't getting the pretty rates. Even on FHA and VA, we're pricing up a little bit for those credit scores. Credit scores in the 700s, of course, are getting the pretty rates. One thing, we have jumbo. A lot of lenders pulled out of jumbo during COVID. We still have been in it the whole time and have, so that's been a kind of a nice niche for us this summer, and still going on with jumbo programs. And yeah, so as far as credit, and also one thing that I think some people initially jumped at the ability to not pay rent or the ability to not make a mortgage, and they put themselves in forbearance. And then when that hits, so we're pulling credit scores that show a mortgage history, and it doesn't show a late payment, but it does show that they're in forbearance. And so we won't refinance that loan until it's brought current, if that's what they're doing. And so, in a way, that the forbearance plan, I think, has been a successful thing so far, at least. Better than what happened in 2008, 2007, when people couldn't make their payments. There was no short-term forgiveness. They were immediately hit with late payments, which took them off the market from getting out from underneath that, either by refinance or selling and buying new. So the forbearance thing, I think, has been for a lot of consumers a really great thing. So.
Yeah. I mean, and what's the minimum credit score right now for an FHA?
So I think there are lenders that'll do in the 500s. We don't do manual, and those would require a manual underwrite. We will do, if I can get an automated approval, we can do an FHA purchase loan. And so I had one a couple of weeks ago that was like a 610 credit score, and we got an automated approval on like a $200,000 house with 3.5% down, which I was kind of surprised we got, but we did get it. But he doesn't get the 2 5/8 rate. He's getting like 3 1/4, something like that. So
okay,
still amazing.
Yeah. And then down payment assistance programs, or what's the status with those? With everything going on, are those still available?
I think they've cut back a little bit. We just do that T-Shack one, and we don't really have a lot of demand for it. Yeah, so I'm not an expert in that in any way. And usually people that are comparing getting a 3.5% gift for the down payment, doing FHA with doing an FHA with grant money for the down payment, the interest rate is significant enough that they really want to go with the regular FHA with a gift versus using down payment assistance.
Yeah.
So.
Yeah. Okay. Well, good. Are there any questions about this for Owen, or any questions for us in general?
I have a couple. Just going back a little briefly to the collections call. And this would be not when something got charged off in collections, but when, let's say, a person has a bill in collections. Is it true that it is detrimental to pay that agreed amount that they offer you, as opposed to paying the whole amount? In other words, the term settled, I heard, was a negative.
So technically speaking, settled is a negative on your credit report. But the way I explain it is, if you take, let's say I have a Capital One credit card, I'm paying fine on it, whatever. And this is theoretical because it's almost impossible to do. I called up Capital One and said, I can't pay this bill. I just want to settle on it. And they said, okay, well, we'll take 40% right now. Okay, great. Here's 40%. It will show then as this account has been settled for less than full balance. And then it will go from being a positive account to being a negative account with that settled language on there. But that never happens that way. What happens is they'll actually tell you, well, stop paying on it for 3 months because we can't really do anything. And legally, at 3 months, we have to, force a negotiation at that point. So once you do that, it's become a collection. It's become a negative trade line already. So the fact that you're adding the word settled to an already negative trade line does not make it any more negative than it already is. So settling it versus paying it in full is not really going to have any different impact to your credit score. So that's why I always recommend to clients to, if they have a collection that's on there and it is something that makes sense to pay, then settling it is the answer, because obviously you can get a better deal on it. Now, the one thing I always caution them is, if you are going to settle it, let's say it's a credit card, it's you owe $10,000 on there, and they come up with a settlement offer of $3,000. So that's a difference of $7,000. You're probably going to get a 1099 for that $7,000. So that's the one thing that people need to kind of realize, that the negativity doesn't really come from the credit score as much as it comes from the fact that you're going to have to pay taxes on that collection difference.
Imputed income.
Yeah.
Okay.
Yeah.
And my second question is, you don't have to be specific, but if I was to recommend you for someone who, was kind of wanted to do a checkup before they start applying for a loan, how are your fees structured, or how do you get paid?
Yeah, so we have 3 different plans that vary in price, service level, and time to completion. Now, technically speaking, since this is a Trek class, I can't really go over pricing on the call, but I'll be happy to email you some more information on this. But we do, basically all you need to know is we have different plans that kind of, we have one plan that is very affordable for clients, and it's much less than, let's say, Lexington Law, even though it's we do more for a client than Lexington Law does. But then we also have a premium plan, like what we said, we talked about. We get our legal team involved. That's probably more similar to, like, let's say, White Jacobs up in Dallas, which charges $3,000 and $300 a month. Ours isn't anywhere near that. Doesn't even touch it. So all of our plans are very, very affordable for what we're doing for the client. But I'll be happy to send you an email.
Okay.
And we'll send that out to everybody as far as the pricing and everything. So,
great. Thank you so much.
Yeah.
Good information.
Any other questions? So did you guys learn something today? Good.
Yeah, good stuff.
Yeah. So the question that we have, that we always ask is, what did you learn here that will impact your business today? So hopefully that there is some takeaway here that you will be able to take back to your business and to your clients and help. Okay. And again, if you get a chance to, like us, and also give us a review on Facebook. And I'm going to hold it open. So if anybody gets a chance to go in and like our page, we'll still do the raffle, and then we'll send off that gift card. So, and then our contact information, we'll also be emailing this out. But Susan kind of covers our Austin and Houston area. You know, right now there's not a lot of in-person stuff. We've never really done in-person consultations anyways. But right now we definitely can't do in-person consultations. So everything we do is over the phone anyways. But we're also available for home buyer seminars. So Owen or any of you guys, if you want to, you know, couple up on any kind of home buyer seminars, happy to do those. They're so simple to do now. It's not like we have to get people together. I remember days where we're like, oh, we got 30 people say they're going to show up, and then 2 people show up because, you know, there's an accident somewhere, especially like if you wanted to do let's do one at like 6 o'clock in the Galleria. I'd be like, okay, yeah, well, let's also, you know, fly to the moon in a cardboard rocket. It's about as it'd probably have more luck doing that than, you know, setting up a meeting with people in the gallery at 6 o'clock. So doing things on online is a lot easier to get people together, and we have a home buyer seminar that we can do. So any other feedback? Owen, you got anything?
No, I thought it was very informative. I learned something.
Great.
I like it. It's interesting stuff, I think, the whole behind the scenes world of credit.
Yeah.
But I need to jump on a Zoom call at 3, so going from one platform to the other. So
All right.
thank you so much.
Thanks, guys.
Thank
Reach
you,
out to any of us if you have any questions. Yes, thank you. You guys have a blessed day.
You too. Bye-bye.
All right, bye.